Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lang, Chief Economist at AirDNA, and I'm joined again today by my trusty co-host, Scott Sate. Scott, happy summer.
Happy summer. Great to see you, Jamie.
So most people don't watch this on video, but I'm seeing you in a new location. Are you out actually enjoying the summer, or is this just a new spot of your house?
It's the very sad reality that it's the exact opposite of me being outside enjoying the summer. I'm in a small office at my house with a very small window. I think it's actually strategic because if I was in a very bright, open concept room, I'd just be sad that I wasn't outside. So I don't remind myself. Ignorance is bliss.
I mean, you're in San Francisco and you guys don't really have seasons anyway.
It's
right?
cold anyway. Yeah. What's been your summer highlight so far, Jamie?
Spent a couple weeks in Maine, which was amazing to get out of the heat of Atlanta because it has been a scorcher, as they'd say in Maine.
Goes to Maine for 2 weeks and adopts the accent.
Right. And then kids are back in session, so it really feels like summer's over. And yeah, short-term rentals still going great. We had some really long lengths of stays this summer. So this is our first summer being operational. And like throughout the spring and fall, it was all like 2 and 3 night stays. And the past 2 guests have been a 14-day stay and an 11-day stay, which
Love to see that.
Yeah, like it's amazing, like what the lack of turnovers do for me, forgetting that I actually own a short-term rental during the summer.
Basically a long-term operator.
Right.
Strong booking season coming up for you, right?
Yeah, and our peak season is September and October. September and October it's typically shorter lead times though, but we're starting to see the fall sort of fill in. But it'd been funny. It was like a lot of bookings like up into the lead up of summer, and our summer was sort of booked up pretty far in advance. And then like we saw it was like 2 months without any bookings. And now we're starting to see the fall get booked. But again, it was like people staying and no bookings coming in. And like, I haven't gotten a message from Airbnb in a long time. Or Vrbo, that was the other fun thing, like just as these surprises as a operator of like, because I'm merchant of record for Vrbo, I got a booking for next summer, July, and the money already hit my bank account. I'm like, I love being merchant of record. Like, this is great. Like, I get to keep that money for a whole year before they actually have the stay. Like, this is awesome.
That is one perk. Don't go spending it. Hopefully that guest doesn't cancel.
Yeah.
Speaking of Airbnb, speaking of Vrbo, we're coming off within the past few weeks.
Wait, you didn't come tell me your summer highlights.
Look, I'm ready to jump into the data, Jamie.
Okay. Give me
My
one
summer, I
highlight.
will tell you, you know why, because we can cover it on the next one. I am making a wager that my summer highlight hasn't happened yet because I'm about to embark at the end of next week for just shy of 2 weeks in Europe. So taking a little bit of international travel.
That's awesome. All right. Your question.
We can jump into the data. Airbnb, Expedia, Booking recently came out with their earnings. Why don't we start with Airbnb's Q2 earnings? A couple notable call outs and announcements there. At the highest level, revenue up, nights and experiences booked up year over year. What did you see in the earnings that stood out to you?
Yeah, one, nights and experience, and everything sort of surprised to the upside versus consensus. So they outperformed expectations, but as typical, the stock went down, and it went down off of sort of forward guidance. So expectations that the rest of the year we're going to get a bit weaker in terms of growth. And it's important to sort of, one, think about the growth in terms of the context of Airbnb as sort of a travel company, and then put it in context of it as a sort of growth sort of tech company. So as a sort of travel OTA, Airbnb saw nights growth of 7%, revenue growth of 13%. In comparison, Expedia was up 6% and Booking.com was up 16%. So Booking and Airbnb seeing above sort of 10% growth on revenue. but nights being below 10% is sort of their and below the line of growth that they want to be at. Like they want to be a high growth company. And for them, being high growth means growing nights greater than 10%. So I know we'll talk about this in a second, but that's really the impetus there, that they are trying to figure out ways to re-accelerate growth above that sort of 7% line. And when you look at supply, they're growing supply at about 10% right now. So that should hopefully mean their sort of near-term growth prospects should be at or near 10%, because we usually see them somewhat in line over the long term. But in their sort of core markets, so think like US, France, UK, Canada, like the big markets that they've historically been in, they're seeing growth of more like 5%. And then in their growth, sort of strategic growth areas, so think like in Germany, Japan, Mexico, areas where they just see that they're underpenetrated in terms of overall travel demand, they're growing at about 13 or 14%. So they are investing heavily sort of outside of the US and outside of their core ones, but clearly the business has slowed, and it's been an overall sort of weak booking environment in a lot of those sort of core countries, US and France in particular.
I like that you've used the word core. I mean, you're using it in a different sense, the word of how it was talked on the earnings call. But that was a takeaway that stood out for me, which was, okay, we need to find a new way to grow if I'm Airbnb in this example. So I'm going to look, in the words of Brian Chesky, beyond the core. And so we've heard them hear them introduce these new offerings as a business or as a even platform over the prior earnings calls and year to date. First, it was experiences. The big hoopla announcement earlier this year around experiences.
Let me stop you there, because we're good at tracking Airbnb supply, and like we've historically only tracked listings. A fun sort of fact is our data team started scraping and analyzing experiences. So, and they've been doing this since 2016. And for reference, there's 8.5 million active home rentals. How many experiences do you think there are globally on Airbnb?
And you are saying Airbnb has been doing this since 2016. Experiences.
Airbnb first launched experiences in 2016. They've relaunched it, I think, 3 times now. But yeah, how many experience listings do they have?
Currently. I'm going to guess a few 100,000, 250, 300,000.
You would be off by a magnitude of about 10x. So there are 27,000 experiences on Airbnb bookable today, about 4,400 of those in the US.
Wow. I would think that number would be a little higher with all the commercials and advertising I've seen so far recently. Now, I guess, Jamie, since we just started tracking that, we don't know what the growth has been since they kind of relaunched this earlier this year, do we?
Or in the subtraction of listings that they saw during COVID, because remember, they're pushing heavily into this in 2019. They're seeing pretty good growth. And then not surprisingly, in-person experiences did not grow for them during the pandemic. Then they sort of paused allowing new experiences to come on, and only just now reopened it with the launch last May. So I expect they have some growth coming, but a lot of work still to do there.
Yep. Hopefully growth ahead there. In terms of other non-core strategies as a business, though, you hear intentional focus around hotels, and specifically kind of smaller, more boutique operators and hotels, and even really a focus outside North America. But still, this signals a direction, to your point, Jamie, on growing beyond their core, growing inventory, and growing to be a high growth business. And this is really intended to address like availability gaps during peak travel periods, or maybe locations where supply is constrained. We saw the Hotel Tonight acquisition. How do you think this impacts the existing inventory or existing hosts on platform?
Yeah, and existing inventory and existing hosts, I don't see this being a major sort of impact there. Only maybe of sort of making it more of a go-to for general travel booking. Like Airbnb wants to be their everything travel app. Right now, I'd argue that booking.com is the everything travel app where you can go to get a mix of hotels, short-term rentals, flights, and it's heavily used in Europe, especially with boutique hotels. And I think that's where Airbnb sees their biggest competitor being booking.com. And where does booking dominate? It dominates in hotels, especially in Europe. Uh, and so Airbnb has a strong brand. And in a lot of the areas where they see consumers coming in to book, they just don't have the inventory that someone wants, maybe in major cities where there's been restrictions and legislation sort of impacting their overall potential growth. We still see fewer short-term rentals in most major European capitals than pre-pandemic levels. So while overall travel has grown dramatically from 2019, their number of available listings hasn't. So yeah, I suspect they're very supply constrained. And given how much sort of marketing effort they put behind their brand and how much direct traffic they see to their site, that there's a lot of growth that they could drive by just having a better match of inventory to all the traffic that they see. So I'm excited about it. We haven't seen anyone really do hotels and short-term rentals right in combination of that experience of like, all right, there's 200 hotels and 20,000 short-term rental listings, but those 200 hotels represent maybe 80,000 listings. Like, and how do you merge that inventory together? How do you bring up inventory based on and what a guest sort of told you about them or the type of stay or the number of guests? And excited that it could be happening at the same time that they've said that they're going to transition into an sort of an AI native app. So we don't know what AI native means for travel, but and the fact that Airbnb's sort of drawn a line of sand of like right now of the 50 most popular apps on a phone, like none of them are really using AI yet. None of them are AI native, and that they want to make that transition next year. So it'll be exciting to see what that might mean. And I expect that would have a much more significant impact on a typical short-term rental host than maybe them moving in hotels. Because still, and 9 out of 10 guests out there are booking hotels. And we've seen massive growth for short-term rentals, but it's still the vast minority in terms of what people are choosing on a day-to-day basis.
Yeah, and that data suggests if they execute this well, it could actually bring incremental travelers to the platform. If they do achieve this strategic vision of the everything travel app, you can get some people who typically want to book hotels on the platform, exposing them to your short-term rental. If you're
and that's what Booking has called out of they're seeing really driving growth of their vacation rental inventory is people that start on as booking a hotel and eventually end up like along that booking process actually booking a short-term rental because that is actually a better product for their stay.
So we've talked about two of them, AI, of course. I mean, I would be interesting to track how many earnings calls mention AI, more like how many don't anymore. So of course, Airbnb is talking about it. Hotels, AI. The third one, maybe not on the earnings call, but a recent announcement was reserve now, pay later. So the classic buy now, pay later we see across industries and sectors has shown up for Airbnb and short-term rentals. So, Jamie, are you in the camp of this is a good thing or this is worrisome if you're a host on Airbnb?
For me, I don't see how this could be worrisome for an average host. It's not changing your cancellation policy. It's actually only available for hosts with flexible or moderate cancellation policies, which represent about 40% of US listings. So vast majority of hosts actually have moderate, strict, or super strict cancellation policies. So it isn't going to be everyone that has this option. And then you think about it in terms of why would Airbnb do this? Because you look at their financials, and I dig deep in their financials. They earned $818 million, almost $1 billion in revenue from interest income last year. And most of that is generated because when you book, like unlike Vrbo, they're merchant of record. And so they hold that money when a guest pays it until when the guest stays. And then 24 hours after the guest sort of starts their stay, I get my payout. And in between that time, they're earning interest income on that money. And as of Q2, they had $11.1 billion just in funds that they were holding on behalf of guests, that's a crazy amount of money. I can't even imagine $11 billion just sitting in your bank account. They're like, well, someone's paid it, but I don't have to pay it out because they haven't stayed. And we're just going to see how much money we can make off of this money sitting in our bank account. So now they're going to say like, all right, we are going to let a guest sort of choose not to give us that money right now. And that they can delay till like 2 weeks before that stay is going to happen for us to actually hit that credit card. So they can reserve it and pay for it later. And for them to sort of take that hit on all that interest income that they could have been earning, I have to imagine that it's because it drives incrementally greater bookings from guests that when their guests now are sort of trained that they should be able to do this when booking is like, if I'm booking a trip for next summer, like, do I really need to pay for it now? Or can I just tell you I'm going to do it? And you charge my credit card when we get closer to that stay. Like if I was a guest, I would much rather like just be able to pay for it a year than going to having to pay for it now for a trip that is a really long time away. So I'm excited about that. I'm excited about how it could incrementally drive bookings to short-term rentals when maybe before they were going to hotels or other forms of lodging because they had more flexible payment options.
This is to your point, Jamie, this is a massive bet they're making because of that interest, like that they could potentially be forfeiting. Therefore, my belief, without actually knowing, is they didn't just arbitrarily make this choice. They likely tested it, did some research, got some consumer sentiment, feedback, or even real market data that led them to make this choice. And so to your point, this is likely going to boost booking conversions. It gives them that opportunity to compete with hotels where in that sector, you typically aren't paying up front. It creates more guest accessibility. And yeah, you're right. Like you can increase bookings because this appeals to what Airbnb was saying as 60% of US travelers prioritizing affordability. And so they're thinking this can increase the demand for those almost 8 million listings.
So Scott, when this was leaked in their terms of service a few months ago, there was a lot of pushback about this online. And
yeah.
So what's the risk here? Like why are property managers worried about this rollout?
I think the risk and concern and worry without all of the facts is on the cancellation, which is, well, that's one, cancellation, and two, like what happens if somebody can't actually make those payments, or if there is a reason that money ends up not getting collected, who's quote unquote holding the bag. So those are the details that I think need to be better understood as you've articulated here, particularly on the cancellation policy. Since this only applies to the 40% who have that flexible or less cancellation policy, it's actually no different in terms of collection. And by the way, as a host, you don't collect your payout until 5 to 7 days after check-in anyway. So it's really not a huge difference for the host. Airbnb is, in theory, taking on that risk.
Right. And I think now, like, what will be interesting, and I know my team is tracking, is with this option now for US listings, do we actually see the cancellation rate go up? Because like someone booked it, nothing's actually come out of their account. Now they're getting to 9 days before the stay. And like you get the notification from Airbnb that, all right, the money's going to come out of your account. And then you're like, oh, like I don't have the money to cover that. Or that was a fun idea to go there in the next couple of weeks, but yeah, like let's not do that. And before it was sort of up to you to remember to cancel before you sort of crossed into that sort of non-refundable period.
Yeah, I mean, it's interesting when you overlay that with the lead time data we've been looking at in the market, because that may be true for somebody who's booking, I don't know, 60 days out, but we're seeing the lead time compress to even shorter. And so that delta between when you're booking and when you actually have to pay is getting narrower. And so likely that cancellation is not going to be as likely if it's a shorter window of time. And then maybe the same can be true. Maybe it's a barbell approach where if you are going to book, maybe you go back to the same vacation home at the beach every single year. I'd love to book it, but not pay until a year later. To your point earlier, keep more money in my bank account.
Yeah.
And so maybe there's a spike in cancellation more somewhere in the middle where there's uncertainty about the trip and this sounds like a good idea in the future, but I can cancel later, as opposed to the very far out or very short term.
Yeah. And we only see slightly higher cancellation rates for flexible and moderate policy. Like it's not meaningfully different, like a percent or two higher on the overall cancellation rate, which is already averaging 16, 17%. Like if you look at overall total cancellations.
I'll tell you one way it could impact host behavior is I'm now thinking, do I move to a less strict cancellation policy to try to capture some of this incremental demand?
Right. And this is essentially an amenity that Airbnb is offering your guests of being able to buy now, pay later that costs you nothing. Like it's not changing your booking behavior at all. It's not changing the revenue you're earning, but Airbnb saying like, we're going to offer this to guests. Like they're offering it because they're seeing incremental bookings. So now maybe we see that incremental improvement of book. We already see flexible and moderate policy listings get booked more often, all else held equal. It's like I think it was like a 15% incremental increase in bookings of like a flexible policy versus strict. So like if you're in a market, you've got relatively long lead times or even short lead times where like it doesn't really make sense they have a strict policy because no one's booking that far enough in advance anyway to make a difference. Like that this could absolutely be a meaningful lever to drive more bookings into your property.
Well, we will monitor the data and see how this plays out. All right, let's jump in quickly here, Jamie, to what we saw in July and what we're looking at going forward for the rest of the year. Maybe a good place to start to set the foundation here is what we're seeing in the economic data. Over the past months, there's been some recent announcements on labor statistics, on where we think interest rates are going to land in the rest of the year. So what are your high level perspective here?
Yeah. And Scott, like I'm just the messenger. Please don't fire me for reporting on the statistics. But we have seen labor market deteriorate pretty significantly. We're still seeing growth, but last few months have averaged job creation about 35,000 per month. And that goes from at the beginning of the year, we were seeing about 150,000 new jobs being added per month. Fortunately, at the same time, we've seen the labor supply market deteriorate as well. So we're seeing less immigration into the country. We're actually seeing net outbound immigration, which has meant that even with the sort of slowing of job growth, we've kept the unemployment rate essentially steady at 4.6, 4.7%. And it's been at that sort of level for the past couple of years. So we're at a very sort of healthy unemployment rate. We are seeing wages not grow as much as maybe we had seen, sort of suggesting that the labor market is tightening a bit. We have also seen, and something I've been paying very close attention to because of our sector, of just what's happening on consumer expenditures, sort of spending. And that one sort of throwing up some red flags. We haven't seen any growth in real consumer spending for the past 6 months. So there's And that's even with sort of a lot of consumer sort of front running tariffs. So I'm not sure if you bought a new iPhone in the in January and February to sort of get ahead of the expected tariffs, but a lot of people did. A lot of people bought new cars, sort of trying to get ahead of the tariffs. So even with all that sort of front running tariff spending, we still haven't seen any growth. So there's a lot of concern for the back half of the year that spending will slow even further, and that we could actually see a contraction in overall spending. And then on the inflation side, we have seen inflation start to tick back up, albeit slightly, but especially in those sectors sort of most exposed to tariffs. So there is a lot of worry that tariffs are causing sort of slightly lower overall economic growth and slightly higher inflation, which if that trend continues could put us in a sort of sticky economic situation, put the Fed in a really tough situation on how to sort of adjust interest rate policy going forward.
Yeah, so we package up all of those data points, pretty simple, and try to spit out some impact onto the interest rates. So if you're Jerome Powell, where do you think, so maybe if you're not Jerome Powell, you, Jamie Lane, where do you think interest rates will land September and for the rest of the year?
Yeah. And fortunately, I do not have Jerome Powell's job. I do not want Jerome Powell's job. But he is going to have a few more data points come in before he's going to make a decision in September. I think all expectations are that they're going to lower interest rates by 0.25%. And you could even see it be a 0.5% if we see another weak jobs number, if you see other sort of indicators around the economy sort of deteriorate. But right now, if you look at the stock market, like I think we hit another sort of intraday all-time high on Friday. Like things are booming. So a lot of sort of conflating signals, and the fact that inflation's coming up a bit. Like I think he's going to lower just to move more towards a non-restrictive policy, because like all else held equal, like we're still in sort of restrictive policy zone where like we have interest rates high enough where they should be slowing or contracting the overall economy. And I think overall he wants to move more towards a neutral stance. And that's what I'd expect. I think that's what most of the markets expect is cut in September, cut in December, and then maybe 2 or 3 cuts in 2026. And that gets us to a neutral interest rate policy. And then we see where the economy goes from there.
Yeah. And so if you connect those assumptions with, okay, then that starts to materialize to lower mortgage rates in the future, potentially.
Maybe.
Potentially.
Yep.
And you overlay that on the current data that was just released around the disparity between home sellers and buyers right now. Play this down the line of what you think happens to home sales, and in particular, impact to the short-term rental industry and possibly supply, call it early 2026.
Yeah. So on the home market, we are seeing the supply of homes start to expand. So more and more homes are coming onto the for sale market. Unfortunately, we're not seeing demand expand. So not a lot of investors, not a lot of people looking to sort of create new households. The lack of immigration is also going to impact home demand. So right now we're starting to see some weakness on the home value side. So if you have more homes available for sale than there are buyers, you'd expect that to sort of show up in terms of weakness on the value side. And if we see any sort of chinks in the armor of demand, like if unemployment starts to tick higher, we start to see job losses. That's the other really important thing on the economic side. Like you look at unemployment insurance claims, like they're not increasing in any meaningful way. They're actually ticking down a bit on a seasonally adjusted basis. So, but if you start to see people start to lose their jobs, you start to see reversals in what's going on in the stock market, like that could lower overall home demand and really start to push prices down. I think that has a double-edged sword for the short-term rental market. Like obviously as real estate investors, we don't want to see prices come down. But given where short-term rental earnings are at the moment, and given where interest rates are, it does not make sense to invest in a lot of short-term rental markets. And lower home values could start to open up some of these areas. So my expectation on the sort of supply side for short-term rentals is the growth that we're seeing, about 5%, is going to maintain. I expect home values to be flat to maybe slightly negative, but probably flat over the next year. I expect interest rates to probably stay the same, and we don't expect them to get below 6% for the next throughout 2026. So there is a lot of expectation already built in to lower a lower Fed funds rate that's sort of baked into current interest rates today. So I don't expect what Jerome Powell is going to do is going to have any meaningful improvement on interest rates. And then on the supply side, like if more people start selling their property, maybe those job losses cause people to need to sell their home. That's where you could start to see meaningful unlock in movements in the housing market. And that would obviously not be for a good thing, but for investors, it could start to open up a new supply at an attractive sort of purchase prices to get in.
Okay. Well, lots to pay attention to from an economic standpoint. Let's get into some of the data here now for July and for the rest of the year. 3 points, maybe I will tee up for you, Jamie, and choose your own adventure where you want to go and how you want to talk about the data. Number one, July, another new record, highest demand. So 26.4 million nights booked in the month of July. Supply growth slowed compared to June and May. So 4.6% growth in July, down from 5.7 in June. So demand, supply. And then last, we continue to talk about this month over month, is booking lead time. So actually we saw this come back. We're now around 28 days. So a bit of a reversion, Jamie, compared to what had been about a 4 to 5 day gap earlier in the year. So 3 data points. We'll let you choose your own adventure here.
Yeah. So on the supply side, our expectation going into the year, there was going to be about 5% growth. We sort of been varying around that. It looked like it might start reaccelerating and with the Maine June data, but we had expected July to come back down, and that's exactly what happened. So there'll be some movements up and down given on the month, but I think the expectation that we're going to stay around this 4 or 5% growth figure is probably wise on an expectation sort of level setting. And then that's a great context to sort of think about demand growth. Because when supply is growing greater than demand, then we see occupancy falling. So start of the year, we had seen about 5 or 6% overall demand growth. Given supply growth of about 4 or 5%, that meant that occupancies were gaining. Now, if we've gotten into the summer, we've seen supply growth around 4 or 5% and demand growth sitting at around 3%, which has meant that occupancy has fallen. So Maine, June, July, we've seen occupancy growth just north of 1% declines, which is, and you never want to be thinking about occupancy declines. So we can talk about demand growth, sort of record highs, and more people staying in short-term rentals than ever before. Like, yes, that's absolutely true. But if supply is growing faster than demand, then if you think about your listing, your business, like you're not seeing more demand than ever. You're seeing actually less demand than last year because that demand's getting spread out over more listings. So I think broadly, it's not a great story on the demand front, and demand's definitely not coming in as strong as we were expecting at the beginning of the year for the summer. And I think a lot of those sort of economic headwinds sort of play into it. Uncertainty is still very elevated. We have had the sort of big, beautiful bill pass, which has absolutely added some certainty of tax policy going forward. It's actually made it a bit more attractive to invest in short-term rentals, given 100% depreciation coming back, and some other things that you can do on the expense side. But overall, we're still seeing consumers wary of spending. And that's absolutely showing in the short-term rental demand side and also on the hotel demand side. So I was just in Nashville at the Hotel Data Conference last week. And on the hotel side, they just lowered the industry level US hotel forecast from at the beginning of the year. It was a plus 1.8% RevPAR growth to now they're expecting RevPAR to fall for full year 2025 by 0.1%. And they expect demand to roughly be flat with supply growing 1%, which means occupancy is going to be a 1% decline for the year for US hotels. So a lot of weakness there, a lot of pessimism. And they see that being driven and with a mix of both on leisure, especially for budget travelers, but also on the corporate side. They're seeing pullback on both corporate, government, and group travel. So all in all, like it's been a weak summer for travel. I'm still growing, but not as strong as we would have hoped. But I will give you some sort of measure for optimism as we look at pacing into the fall. So demand pacing is up anywhere from 7 to 9% coming up this fall. So we are seeing and expect maybe occupancy to turn back positive as we get into October, November. And a lot of that has to do, if you think about and what was happening last October, November. Do you remember?
Oh, something like an election?
Election, yeah. Election. And that was our sort of first round of increased uncertainty and sort of bookings pulling back. And we're finally going to get maybe a weaker comp to grow against. So, yeah, a lot of noise out there in terms of signals. But I'd say we're not seeing any sort of flashing red, like overall recession indicators. We're just seeing some and you can sort of pick and choose. And I could show you a chart showing the stock market and you think, Jamie, like things going to be better. And then I could show you the chart on consumer spending and you're like, Jamie, that sort of points to like a recession. And so maybe depending on how good you're feeling on any given day might be a good indicator of like what the outlook might be.
And that's what your guests are likely feeling as well, is that volatility. And so that's why you may see the volatility in booking lead times, demand nights. But I think
and that's and the sort of follow up there is the weaker booking lead times we had seen coming up into the summer. Still showing up on the lead times on a stayed basis, but we are seeing sort of as we look into the fall, like, and what's getting booked today, like lead times are normalizing. So that gives me more confidence on the consumer side too, that things have absolutely turned around some from this spring when uncertainty was at all-time highs to now where it's come down quite a bit and people, and if they're going to travel, they're feeling confident to maybe book that travel, or at least as confident as they were feeling last year.
Great place to end it. Great episode, Jamie. That was a lot of fun. I think one last parting comment, if for anybody listening out there who has endured this, I think we're approaching 40 minutes here. A little reward for you. So exciting this week, AirDNA is formally launching a brand new product for property managers. So if you're a property manager, you've made it this far, you're committed to the business, you're committed to the industry, message Jamie or me directly. We'd love to show you the new tool and give you a discount. So Jamie, this was a lot of fun and excited about what's going on inside AirDNA.
Yeah. Hope you have a good trip to Europe. Excited to hear about it on our August review.
Can't wait to give you my highlights.
All right.
Thanks, Jamie.
Thanks, Matt.